right, let's get things going. So, everybody, welcome to today's webinar. Appreciate you taking the time to join us today for another Investor Power Hour. Today, we have with us Anton Mattli, where we're going to be discussing how to navigate the multifamily financing space. Anton, you'll let him give a proper introduction, but he's got a very colorful background, very significant experience in this space. And if you've been around the really commercial real estate in general, but specifically in the multifamily space at all for the past, call it decade plus, you would know about Anton in some capacity. You've probably seen him around. He's been on plenty of stages, plenty of introductions and presentations given about this. He is a wealth of knowledge when it comes to financing in general, and he is our go-to gentleman when it comes to financing in this space and all of our deals. So with that, Anton, if you're ready, let's go ahead and get things started.
Hey, Tarek. Great to be here. You want me to start sharing the slides?
Yes,
And
go ahead, share your screen and we can get things going.
okay.
And right before we get started, Anton, for the folks on the call, any questions that you may have, please, you can enter them into the Q&A section of the Zoom chat room, and we'll have a Q&A session at the very end of the presentation where we will go over those and make sure you get those questions addressed. So apologies, Anton, go ahead and continue.
Sounds great. Hi everyone. Just a little bit of a brief introduction. I'm from Switzerland. I was born in Switzerland. And I studied finance. Right after school, I went to work with one of the largest investment banks, UBS. I worked in New York, Tokyo, and Hong Kong. And after that, I left investment banking and started my own investment firm, as well as related to that brokerage firm that's around 20 years ago. And so today I'm speaking with you about multifamily finance. And when I talk to you about this, again, I'm talking to you based on what we have been seeing in the market, but also kind of just going back once in a while to a little bit further back in the last 10, 20 years of how situations can change pretty quickly. And as all of you know, over the last few years, we have gone through quite a few changes in the debt market, which also has had a very significant impact on multifamily and other commercial real estate. So let's start the all-important Fed rate and the related SOFR, which is the secured overnight financing rate, which really is a, a rate that replaced roughly a year ago to 2 years ago the London Interbank borrowing rate. But it doesn't really matter whether we call it SOFR or LIBOR. SOFR just has replaced LIBOR as the financing index for all short-term commercial loans. So that is very important as an index. And what is important for all of you to understand is that SOFR is closely tracking the Fed rate. So the Fed is meeting today and tomorrow. So we obviously will get some news soon about where we stand with another rate cut. I think the market anticipates another rate cut. Whether that will be 25 basis points or 50 basis points, we just do not know at this point. But I think what is certainly important to highlight is that when we look at this forward curve here, and that is really important. It's not that important to look back where we were. We all know we were at virtually zero interest rate environment, as you know, with the Fed increasing interest rates very rapidly, starting in the mid of 2022. We then saw also the short-term borrowing cost for any short-term borrowing, specifically also bridge loans and construction loans, going up significantly. So right now we are with the sulfur just around uh, 4.3 or so, 4.5, 4.35 as an interest rate, which essentially indicates that the market believes that also the Fed will cut uh, the the guidance for the Fed rate by another 25 basis points. So then we would essentially be aligned with that. Now, what is, I would say, important to understand is what you see here are the current projections by the Fed commissioners, by the various individuals, and the one that is a dark dot is the Fed median assumption. So when you look at this, then you will say, well, by December of 25, right now the Fed commissioners believe that the Fed rate will be somewhere down at slightly below 3.5 as a median. Uh, so that would mean that we will have another 1% to 1.25% cut over the next 12 months. Whereas the interesting part is when we look at the forward curve for sulfur, what the market participants foresee is they do not really trust that much anymore. In the past, it was closely tracking the median. Now we have a sulfur that essentially by next year, in roughly a year from now, that we are just slightly below 4%. So that would mean just around 50 basis points in cut. So obviously, we do not know where we are going to go. It could well be that sulfur will also end up at 3.5%. But I think what the overall message here should be is, look, yes, the Fed is likely going to cut, but do not expect a significant amount of reduction. Now, we already are down roughly 1%, so that has given us a lot of relief, and then we'll touch on this a little bit later when it comes to only borrowing cost as well as interest rate caps for anyone who needs to renew an interest rate cap or uh, get uh, get a new loan that is a floating rate loan. Now let's have a look at, so that's the sulfur forward curve. So now let's look at where the 5, 7, and 10-year treasury stands. Now, why do we look at those indexes? Because that's what majority of commercial loans, permanent loans, are priced on, whether it's a swap or a treasury based. The swap rates are very close to that. So the reality is the majority of all commercial real estate loans or permanent loans are closely tied to the 5, 7, and 10-year treasury yield. And you may recall in September when the Fed started first cutting, then many uh, uh, in the investor space celebrated and said, oh, now the rates come down, right? So now that is only true, as I mentioned before, when it comes to sulfur. Yes, that has come down, and yes, that will likely come down by another 50, maybe 1 basis points, maybe 1% over the next year. That, however, does not mean that the 5, 7, and 10-year treasury yields are coming down. As a matter of fact, when we look at when the Fed first cut in September, the 10-year treasury was just around 3.6%. Now we are close to 4.4%. So 80 basis points above of where we were when the Fed started cutting. So the market defines where the yield curve is, and so only the long end, the Fed and the Treasury do not really have control over unless they are starting to implement so-called yield curve control. Japan and Australia have done it in the past, so it doesn't mean that the US couldn't do it. But so far, at least, they certainly haven't done it. But even if they implement some form of a yield curve control, it's very unlikely that you will see a significant lower 5, 7, and 10-year treasury. Particularly, there is clearly some indication of inflation pressure that is still happening out there. And at the same time, the economy still has shown some some positive growth. Now there obviously are mixed messages out there. Every day we get a little bit of different messages from the market. So it obviously, if we have a significant recession that we are certainly facing, significantly higher unemployment, it could well be that that yield curve will come down and drop again into the mid threes. But I would say from a borrower perspective, if you have a bridge loan or construction loan that is outstanding, do not expect that just because you wait for another 6 months, because you hope that the Fed is cutting rates, let's say by another 50, 75 basis points over the next 6 months, that your permanent financing will have take any benefit of that. So this forward curve, that's what the market currently thinks. It may change, but if you are in the need to refinance over the next 6 months, just work with the assumption that your borrowing costs will likely not change at all. It potentially could be slightly higher. But right now, we essentially talk about a flat curve all the way all through from today to the end of 2025. And that's what I would recommend whenever you look at your at the next 12 months of your strategies for refinancings or acquisitions, that you essentially have to assume that that is still to be the case. So this is a combination of the two, SOFR as well as the 5, 7, and 10-year treasury yields. And again, when you overlay this, obviously together with the expected Fed rate cuts, SOFR will come down likely over the next 12 months. So that is positive, but it's not nearly as much as many of investors think it is going to be or hope that it will be. And as I said before, when we look at where the 5, 7, and 10-year treasury yields are, at least the market, and again, that's what the market thinks, there doesn't seem to be any relief there to get to lower rates. So you essentially have to make the assumption that we are, when it comes to permanent financing, right where we are today. Now, obviously, when it comes to selling a property or refinancing a property, the borrowing cost is important from a debt service coverage perspective. But many of you also have hoped that with the Fed cutting rates, that we will see a relief in cap rates on properties, including multifamily, where as the 5, 7, and 10-year treasury comes down, that the cap rates for these properties also will come down. So we do not know, right, where that is going to go, but it's still unlikely that we will see a further compression of the cap rate uh, without the 10-year treasury also coming down significantly. So now we do not know. So when we look at what CoStar is projecting, and this is for all of the United States, obviously there are significant differences from market to market. This is specifically for multifamily. Uh, for industrial, it's different. For self-storage, it's different. For offices, it's completely different. But when we look at multifamily cap rates, what CoStar is projecting, they see that we will have over the next year just a slight reduction of the cap rate. Now, is that going to happen? We do not know, but assuming that the 10-year treasury will be essentially flat, uh, you could assume that maybe if there is still a lot of so-called dry powder on the sidelines, that the cap rates might contract a tiny amount, but it's very unlikely that is going to be substantial. So if you look at the valuation, when you say, well, interest rates are 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 not coming down, uh, now valuations will likely also not going up significantly again, because unless you can boost your NOI significantly, you will still be stuck with these cap rates for a typical Class C property that is likely in major markets around the 6% mark, and even for a Class A, you will probably be somewhere in the 5 to 5.5 mark. Right? There are always exceptions to that, but expecting a significant improvement on the cap rate side is probably not the smartest thing to do when you go into a deal. We have seen some deal sponsors that are essentially making assumptions that cap rates will come down significantly over the next 2 years, and that's a pretty risky play. So I would advise not to go with that strategy. Now, when we talk about cap rates, uh, uh, different people have different opinions how cap rates correlate to the 10-year treasury. Obviously, it's not a perfect correlation, but it only has an impact on the so-called risk-free return. And expecting cap rates to significantly contract below where we are today, while the 10-year treasury is essentially expected to be flat, I would say is still very unlikely. Now, if we have a recession that is a significant recession that is hitting us, not just a soft landing, but a significant recession, a severe recession, the 10-year treasury may actually drop quite a bit, well below of what currently is being projected. However, let's go back to 2007, 8, 9, and 10. Even though the 10-year treasury dropped, even though also the Fed rate cut rates, cap rates actually went up. So keep in mind that if there is a lot of distress in the market, just because the 10-year treasury comes down, doesn't mean that the cap rates come down. It actually could be the opposite, where the spread expands and cap rates are turning higher, even though the 10-year treasury comes down. At the same time, when we have a severe a recession, you may also have much higher credit spreads, so that instead of, let's say, being able to borrow today at the 10-year treasury plus 150 basis points, so let's say just around 5.8, 5.9% for a 10-year loan, let's say, agency loan, that spread may go up to 200, 250, 300 basis points. So even if the 10-year treasury comes down, once you add that higher credit spread, because there is a lot of fear in the credit markets, your borrowing cost actually might be the same or even higher where they are today if you're actually able to borrow. And when we look back to 2008, 9, and 10, uh, very often it even didn't matter what the interest rate was. If you were not able to actually get a loan, the interest rate doesn't matter. And back then, the CMBS market dried completely up, and Fannie and Freddie were really the only lenders that were actively out there for multifamily properties. But for that, you needed to have the right valuation. You still needed to have the right debt service coverage ratio in order to get into these loans. So just keep that in mind, that as we shift into a different environment that is not anticipated today, particularly a severe recession, all bets are off. Yes, the interest rates may come down, the yields may come down, but you do not really want to wish for significant reduction in the 10-year treasury yield in a very short period of time, because that would signal distress in the market, which makes it very hard to get financing in place during that period. Now, uh, This is a chart by Chatham Financial. They call it the hairy chart. And this is really important whenever we have discussion about interest rates and having forward-looking discussions, that the market tends to be always wrong, right? And so when you look at these dotted lines here, which you can call the spiky hairs, or projections of where the interest rates are going to go based on the forward curve, similar to the forward curve that I have just shown you for SOFR, uh, at any given point. So the market at this point here, where the red dot is, thought that interest rates will move up over the next year or so like this. But in reality has happened is that the interest rates came down, right? And when you go through the whole process here, there has been the market tends to be always wrong. So whenever we discuss forward curves, keep in mind that that is just a snapshot in time, and the market might be right or the market might not be right. Obviously, here the market was pretty correct, but then when it came to increases right in September, in middle of 22, late 21, and then into the middle of 22, the market was much more conservative when it came to interest rate increases until, as we know now, they had to adjust on an ongoing basis until they realized, oh, the Fed is raising rates much stronger. Obviously, back then it was significantly driven by interest rates. So now with SOFR being lower, that only has an advantage. Many of you have had interest rate caps on bridge loans, and many of you also had to renew those interest rate caps. Usually, even when you have a 2 year or a 3 year interest rate cap in place, you tend to uh, renew that interest rate cap by just 1 year because your extension with that bridge loan tends to be also for just 1 year. Uh, so for a 10 million loan amount back in May, that cost for a 2% strike rate would have been roughly 324,000. Now, when we look at where we are today, that's around 230,000. So with the lowering of the Fed rate, which has a positive impact on SOFR, and the general view that the Fed will cut more and SOFR as a result will also come down, that has a positive impact on the interest rate cap rising. Now, that is still very expensive, but it's still much better than where we were obviously in May of this year. So uh, reality is, right, for a $10 million loan in 2021, when we had record low interest rates, you were able to get a 10 million for 3 years interest rate cap for roughly 35,000 or 0.35%. Now, your renewal just today will cost you for just 1 year for the same 2% interest rate cap would cost you 230,000. So obviously still very expensive. However, it's still around a third less than we were just 7 months ago. So that is certainly a positive development there. Now, with interest rates on the longer end not really moving down as much as many have hoped for, and as you know, many are uh, in the process of having to extend the bridge loans and not really having a chance to refinance into a permanent loan. Uh, and with interest rates for the 5, 7, and 10-year being still very elevated, that creates a problem for a lot of borrowers that are in these bridge loans. Now, that really creates quite a bit of opportunities for buyers, right? So unfortunately, if you are in one of these bridge loans and you went with maximum leverage, not everyone has a problem, but it's only everyone who has gone with maximum leverage, potentially added preferred equity on top of it, they all have a problem with those bridge loans. So now this is a chart by CreditIQ. They are tracking all the securitized loans. And when you look at all the loans that are outstanding, that are securitized, that includes Fannie, Freddie, bridge loans, CMBS loans, uh, when we look at multifamily, which is the left column, uh, we are up roughly at 11% of a distress rate. So now what does that mean? Essentially, any loan that is in special servicing and or is 30 days or more late with the payment. So that doesn't mean that all of these loans now go into foreclosure. That's definitely not the case. However, it shows that there is a significant amount of distress in the market. And you have probably seen charts by some people presenting with the fact or their assumption that there is no distress in the multifamily space, highlighting the fact that when it comes to Fannie and Freddie loans, that the distress rate might be 0.3%, maybe 0.5%, so very low by historical standards. That is certainly when it comes to Fannie and Freddie, so far definitely the case. However, it's only on the CMBS and particularly on the CLO side, which are all the securitized bridge loans, there is a significant amount there. And our assumption is that around uh, around 50% of all the bridge loans are essentially in a distressed situation where they require an equity injection if they wanted to get refinanced out into a permanent loan at around 6%, where we currently are. Maybe you can buy down and then the overall rate might be 5.4, 5.5% with the current treasury yield. But the reality is we are very close uh, to that 5.5 to 6%. Most of these deals were underwritten to 4% or less permanent financing. So this is really, even if you achieve your NOI that you originally projected, a lot of these deals are just not able to refinance out of it into a permanent loan without any equity injection. And because cap rates are higher, because the borrowing cost is higher, there is also very often a very tough situation to find a buyer that is willing to pay the price to get you out of that bridge loan without some form of an equity loss. So this obviously, if you're on that end, if you already own a property and you are in that distress situation, that's the bad news. If you're in a buying position, this is the good news. And when we look at the opportunity for 2025, a lot of these deals, bridge loans have been modified, so-called we're kicking the cans down the road. That is unlikely going to happen again once these modified loans mature, unless a deal sponsor has very strong financial strength, so where they are able to inject their own money, or they have a strong investor base that is willing to inject more equity into the deal to again modify that deal again. Many have run out of steam. So this is where we see a great opportunity for any of you who have the ability to buy. As you know, in 2023 as well as now for this year, the amount of properties that have come to market for sale in multifamily has been very low, and this is a result of essentially nobody was willing to sell unless they had to. Now, those that were able to kick that can down the road with low modifications, they didn't have to sell. What I foresee is that that comes to an end next year, over the next 12 to 18 months, and that will create a lot of buying opportunities. So, what I recommend is for any of you who uh, are getting ready for next year, keep that in mind. Line up all your investors, get your team ready so that you're able to take advantage of these opportunities. Right. So now let's quickly talk about what are your options if you are on the acquisition side. Uh, when you essentially have two options, right? So if it's a stabilized or a so-called light value add property that is already 85% or 90% occupied, you obviously have many options, and it all depends on the strategy that the team has, on the financial strength the team has to decide in what direction they want to go. But solely fixed rate permanent financing is a very common strategy. Obviously, Fannie and Freddie are always on top of it. If it's a smaller deal, you can go with the Freddie SPL because their step down prepay pricing is so attractive that you would want to do it. If you go with a larger so-called conventional Fannie and Freddie loan, step down prepayments are really too expensive. So there you're best off just to reduce the prepayment penalty period. Uh, you also, and we see it's only with the more aggressive as well as more institutional type of investors that they are betting on lower interest rate on the short end, like with SOFR, and that they are willing to go with a floating rate perm loan. Obviously, that requires that you buy interest rate caps. Now, a lot of these loans, they do not require that you buy an interest rate cap for the full period, but for let's say, for 1 or 2 years. What I would recommend is that if you go in that direction, that you buy the interest rate cap for the whole target whole period. So not, let's say, if it's the whole period is 5 years, even if the lender allows you to buy an interest rate cap for just 2 years, I still would recommend that you cover the interest rate cap for the whole period. So you essentially cap that cost for the whole life of your holding period, target holding period, but you still could take advantage of lower short-term interest rates if they happen to come to fruition, which again, some players only believe it. And when we look at the SOFR forward curve and Fed assumptions, that seems to be at least the case right now. Now, for those that can go with lower leverage, life insurance companies can be pretty attractive because they have lower interest rates. But again, for syndicators, very often that's a little bit of a challenge because the leverage tends to be too low. And for higher quality assets and for someone who really has more kind of a generational hold, uh, it might be worthwhile to look at a HUD loan as a final execution. But when you buy a property, the seller typically is not willing to wait for you to do a HUD loan because it takes 6 to 8 months to complete. So you would have to go with a bridge loan that is already underwritten into a HUD loan. So you do the bridge loan initially with while you then work on the HUD loan to get all that financing in place so that you can close out of that bridge loan within 6 months or so into a permanent HUD loan. So that would be another option. Now, if it's a heavy lift acquisition, it's essentially you have to go with a bank or a bridge loan, right? Because you cannot get permanent financing. You just have to underwrite conservatively enough so that you can have a exit into a permanent financing at today's interest rate and a little bit higher in 3 years from now, so that you're able to actually achieve it. So that is very different from all the bridge loans that were taken out in 21 and 22, where many were stabilized deals, but people took out bridge loans just to get the leverage up, right? So here we really talk about true heavy lift value add deals where a bridge loan obviously is the only way to get that financed. Now, if you have a maturing loan, and obviously many of you do, particularly bridge loans that are now have already been modified or coming due for the first round after 2 or 3 years, uh, if the property allows to get into a permanent refinancing, meaning it's a stabilized property and you potentially have opportunity for a cash out, cash neutral, or at least just a very limited cash in refinancing. So you do not have to bring any equity to the table or very little, or you have an opportunity to cash out, then obviously a permanent refinancing only makes sense. Similar to for an acquisition, if you can get a fixed rate perm, ideally with a reduced prepayment penalty period or a step down prepay, that only makes sense. So now keep in mind, right? So if you're already 3 years into a deal, you may not want to hold that property for another 5 years, but even though you may get a permanent financing for 5 years, so it might be worthwhile at least to reduce the prepayment penalty down to 3 years or so to reduce the yield maintenance if you have to repay that loan. Uh, Now, if you're constrained from a loan proceeds perspective and you want to reduce your cash in requirement to do that refinancing, very often, and we have done that a number of times now, is to do interest-only CMBS loans. That can be a 5-year loan or a 10-year loan, depending on holding period, but many do a 5-year loan. And because even though the credit spread over the 10-year treasury or swap rate or 5-year treasury or swap rate is higher than for an agency loan, because these interest-only CMBS loans for the whole term of the loan are underwritten for interest only. And as a result, despite the interest rate being 50 basis points to 1% higher than an agency loan, you may still be able to get around 10% more in loan proceeds. I do not really recommend to go with a CMBS loan unless you just have to go for maximum loan proceeds, but that is definitely an option that you should consider when you do not have any other opportunity to get out of your bridge loan. Now, if you have an imminent sale in mind over the next 6 months or so, then you do not want to go into a permanent financing and then be stuck with a prepayment penalty. So then you're really better off just to extend that bridge loan for another 12 months. Now, if the property is not ready for permanent refinancing, obviously, then it's a different story. Then you essentially have two options. You extend the loan without a modification if your covenants allow it. So if your loan agreement essentially allows you just to go to the lender and say, "Oh, have an extension option. I pay you the extension fee, so we do it for another 12 months." That's the easiest. But very often that is not necessarily the case because you may already be in a technical default in with that loan agreement. And in that situation, you may go with a loan modification of that loan. And frankly speaking, even if you could technically extend that loan without the modification request, you may still want to ask for it so that your extension period has some more attractive terms, either a higher interest rate cap or whatever it is, to reduce your actual cost to extend that loan for another period. All right, Tarek, so that's uh, what I wanted to share with you guys today. So I don't know whether there are any questions or whether you have any questions.
Great. Thanks, Anton. Appreciate that. Like I said earlier, Anton knows pretty much every stone to turn in this business. So super insightful, super helpful. Appreciate that, Anton. For anyone on the call who has questions, please go ahead and in the Zoom chat room, go ahead and click on the Q&A option, the Q&A button, and enter your questions there, and I will queue them up for Anton to go and address them for you. So let's give it a second. Anton, do you think we will ever see 3% interest rates again in our lifetime?
All in borrowing cost interest rates, you mean?
Yeah.
Yeah. Uh, it could well be, right? If we have a severe recession, that definitely could happen, right? So, as the Fed increased the rates very quickly, starting mid of 2022, uh, to essentially fight inflation, uh, it certainly could happen that if we have a severe recession, very significant unemployment, that they cut the Fed rate very aggressively. Uh, could that mean that once they are done with the cutting, that you would be able to, again, to be down at 0.5% of a Fed rate and the sulfur? That could well be the case, right? Right at that point during the storm, your borrowing cost will likely not be in that 3% range, because no one wants to lend to you at that point because it's a storm happening. But as the storm clouds disappear, I would say there is always a reactionary period when the Fed again keeps the rates down, as we have seen, right? That post-COVID, they didn't raise rates for a long period of time. And it could well be that then we go through a very similar period where we may have 1 or 2 years of very low Fed rate and sulfur, which then will, in once the credit markets are open again, that you then have a spread of, let's say, 3% above that. And you might be close to 3%, 3.5% during that period. The 10-year Treasury and 5 and 7 year Treasury, when the storm is happening, it may come down, but again, your borrowing costs will likely not come down to that level because no one wants to lend to you and the credit spreads are higher. But as the storm clouds disappear, they're similar to the sulfur side, the short-term floating rate side. It could well be that if the 10-year Treasury, let's say, is down in 1.5%, to 2% during that period, and the credit markets open up again, that you might be again in the low threes to mid threes for a 5, 7, or 10-year loan during that period until everyone wakes up and then we have inflationary pressures and then we probably are back to where we are today. But unless there is a severe recession happening, I do not see that we are going to be there anytime soon.
Okay, fair enough. Here's another question we got, which is how difficult is it to correlate cap rates with 10-year treasury rates?
Uh, yeah, it's a tough question to answer. Historically, I would say when we look at multifamily, it has fluctuated somewhere between 150 basis points to 300 basis points above the 10-year Treasury. And obviously, when the market is fearful that spread is going to expand, and we have seen it in 2008, 9, and 10, even though the 10-year Treasury came down, cap rates expanded. So right now we are for somewhere, obviously it fluctuates quite a bit, but we are in 1.5 to 2% spread, which is, in my view, pretty tight spread to begin with. Uh, but it's only depends a lot on the credit markets, how liquid the credit markets are, and the overall sentiment in the marketplace, right? So I would say, generally speaking, there is still a lot of dry powder on the sidelines, which certainly had a positive impact on keeping the cap rates where they are today, even for C-class properties. So I would argue very quite a bit of deals that were closed this year from a financing perspective were pretty tight for the buyer to actually accomplish, which means that there is a lot of dry powder out there for the few deals that are actually available for purchase. And during that period, it's only has you see a pretty tight spread. Uh, Now, if there are more deals coming to the market, and we may see a little bit more of distress overall, which also may mean that some lenders may pull back, that spread may very well increase, right? So, but I would say uh, it's only still a- there is still a very significant correlation, because ultimately uh, the typical buyer cannot operate with a negative leverage for an extended period of time, right? And so your borrowing cost, even if you buy essentially just around your borrowing cost from a cap rate perspective, you cannot go below that for an extended period of time.
Understood. So let's look at this next question, which is there's a lot of uncertainty with the upcoming Trump administration. Do you foresee changes and tightening in the LTV in multifamily section in 2025? And how much reserves should investors hold facing the uncertainty?
Yeah, so I do not really see that LTV requirements or loan to value requirements are going to change dramatically. Uh, they have been uh, pretty stable for years now. Uh, it's pretty common to have, again, for agency loans, that you can go up to, depending on the market, 75 to 80% maximum loan to value. But because you have the debt service coverage ratio, that is the other constraint, uh, or uh, or debt yield, but in most instances it's the debt service coverage ratio. You are, in most instances, really constrained right now by the debt service coverage ratio anyhow. So very few deals actually go up to the maximum loan to value to begin with. Uh, Now, when it comes to reserves, I don't know which reserves one talks about, but when we talk just about operating reserves, obviously different operators have different views of how much reserves they should have. I personally would like to see 6 months of NOI so that you have plenty of cushion there, but I know some operators are comfortable with 3 months. Uh, so it all really depends on your strategy. Also, if you are really strong as a sponsor or a property owner with a lot of cash that you can inject at the moment's notice because you just have access to that cash, or to investors, you may be comfortable with a lower operating reserve. But if you are dependent on investors to inject more capital if something happens, then I would say you should really increase your operating reserves so that you're not running out of that operating reserve money very quickly. And uh, I was at an event just last week, and where we have had that discussion a couple of times, right? So it's particularly in markets where you have a pretty high risk of of storm damage. You always have to keep that in mind. Yes, you may have insurance coverage, and yes, you may have business insurance coverage too that covers you for 12 to 18 months of lost income. The problem is that you essentially have to start the rehab well before and pay for it well before you get any insurance money back. So just for situations like this, particularly for properties in storm-prone areas, I would say I would be more conservative when it comes to reserves so that you have access to that money to actually start repairs well before you get the insurance settlement, which can be anywhere between 6 months if you're lucky to 2 years or even longer, right? I know of a case where the property sponsors they injected almost 4 million before they ever saw a single check from the insurance company, right? So obviously that's an extreme case, but I would say that is what I would keep in mind.
Okay. Maybe a similar follow-up question is that Trump has kind of made comments about wanting to allow the president to influence the Fed. Um, how do you think that would affect things?
Yeah, obviously everyone wishes that one can influence the Fed, right? If you can tell someone, okay, lower the rates, and do this and do that. Again, also do a yield curve control where you control the 10-year treasury yield or whatever it might be. I do not really foresee that there is that much of influence that one can have. And ultimately, the challenge that we certainly are going to see, if let's say Donald Trump says, "Oh, I want the interest rates to come down very rapidly," uh, he may have that influence. I do not believe he does, but even if he does and interest rates are cut, then within a year we will have inflationary pressure, and then we are back to where we were in 22, and then everyone has to face higher inflation, and the Fed has to raise interest rates at that point. Uh, but as overall, I do not believe. Obviously, he likes to push the envelope there, but I do not really foresee uh, that it's going to be such a strong influence.
Okay, great. And then maybe one more question is, do you feel like the pricing on interest rate caps make them worth buying currently?
Uh, Generally, I would suggest no. Uh, because the risk that the short-term interest rates will come up over the next year from where we are today is relatively small. So what I would recommend, and that is what I briefly mentioned when it came to the if you have a maturing loan, particularly bridge loan, and you need to extend that loan, even if you do not have to do it with a loan modification, that's a point where I would suggest go to the lender and actually negotiate an interest rate cap strike rate that is higher than what the loan agreement originally had in place, right? So a lot of these loan agreements had a strike rate somewhere around 2, maybe 2.5%. What I would suggest is instead of buying an interest rate cap at 2% for the next year, uh, negotiate one for 5.5% with the lender, and then use the money that you save and put it into an interest reserve account so that the difference between the two essentially can pay for your monthly debt service payment. While if interest rates come down, then obviously the cost comes down. And if you sell the property or refinance the property, you then obviously get out of that loan anyhow, and whatever money in that interest rate reserve you haven't used, you get back, right? compared to buying that low strike rate interest rate cap that the money is gone. Once you pay for it, it's gone. Yes, technically you can reverse it, but ultimately most of the money will be gone up front, and you don't have a chance to recoup it.
I think those are all the questions that we have for now. Definitely appreciate the time and the knowledge and wealth of expertise you share with us, Anton. And everyone, appreciate your time for joining us today for this month's Investor Power Hour. And we will be having our next one.